Welcome to the Del Walmsley Radio Show. Del challenges the status quo, questions everything, and empowers you to return to your core beliefs to make your life better. If you're ready to hear the truth and get your roadmap to the lifestyle you really want, the next hour will change your life. And now your host, self-made millionaire, national award-winning investor of the year, CEO and founder of Lifestyles Unlimited, Del Walmsley.
Welcome to the Del Walmsley Radio Show, where the hype ends and help begins. I'm your host, Del Walmsley, and as always, we're working on your financial freedom. Well, today, my friends, I'd like to take up where we left off yesterday. We were talking about the 3 rules of investing, and we were only able to touch on the first 2. And I would like to go ahead and tie in the third one because it's so very important. It's going to take a lot of communication to get this across, so I'm going to open up the phones right away, because if you've got a topic that you're interested in bringing up, I'd be just as happy to go ahead and cover it with you. Our number here is 866-945-6565. That's 866-945-6565. Our number here is 877-655-6755. Again, that's 877-655-6755. And those phone lines are open as we speak. Now, let's talk about yesterday. We started out talking, first lesson that I ever learned in investing was don't lose money, which for the average person just tuning in for the first time here is going to go, that's ridiculous. Everybody loses money when they invest. It's exactly the way the world was set up, and we expect it to work that way. And as I spoke to you yesterday, I disagree with it totally. I've never lost money investing in real estate. I did lose money in the stock market, and that's why, I went and looked for something that I had more control over, something that I could keep from losing money, and instead of something where you roll the dice each day and hope that you come out the winner that day. Instead of, heads I win, tails I lose, it's heads I win, tails you lose. I always win. It's good to be king. And that's why I get into real estate investing, because it is a win-win-win situation for us. The second thing we talked about was cash flow. And the bottom line is that if you don't have any cash flow, you can't retire. And that is the major difference between what I talk about and what other people talk about. Is I'm here to get you retired, not in 30 or 40 years, but in 2 to 5 years, I want to be able to put you out of your job and give you back your life that you would love to have for the rest of your life, making as much or more money you made back when you had a job. Looks like lines are starting to light up already. We've got Mike here from Sugar Land. Mike, how can we help you today?
Hey, Del. Love your show. Thanks for it. My question for you is, I've been trying to listen to you and do some homework on today's real estate market. I currently own my own principal residence, and I have 2 rent houses. And I'm a Lifestyles member, and I'm either considering going passive in a multifamily deal currently, or continuing on buying single-family houses. But the other thought is for me to go ahead and buy my own apartment complex. But my question for you really is about this market that we're in, because what I'm seeing is even the prices for single-family and multifamily have gone up. But what I've realized also is that interest rates are still low and rental rates are high. Ergo, cash flow is still good, and like you said, cash flow is king, and so it's still attractive to me. But I'm sitting on some cash, and I'm just wondering, do I continue the course and invest now, or should I stay in cash and sort of wait for prices to drop, or for us to as you said, that what goes up must come down, and so do I wait it out and wait for the crash and then buy and get unbelievable returns like everyone did 5 or 6 years ago, or do I just continue to invest?
Mike, did you happen to hear my first hour of my show today from 12 to 1?
I caught the very end of it, which intrigued me, and then you came right back on. I'm like, what? Because I didn't get to get in at the end of your last show.
Oh, that's a shame. That's a shame. Well, I'm gonna at the expo go through that entire process that you've just brought up here. But the last hour I covered it a little bit. I'm going to cover it again later in this segment here also. But the bottom line is that everything that I'm hearing, seeing, reading, and talking to the economists that I know, and I call them up every year before I do the economic forecast, is that it's going to be an up year in almost everything. And so houses are going to go up higher in value. Apartments are going to go up higher in value. Rents are going up higher still as we speak. In fact, I was just going through with my supervisor the other day how much she was afraid to raise rents because I've raised rents so much in the last 2 years. And I've still got people that, I could raise more. Should I raise them? I said, absolutely, go ahead and raise them. And so in answer to your question, everything out there is saying yay. There's almost nothing that's saying nay. So you got to ask yourself the question that you're asking. And I want everybody to ask, where should I position myself when we know that we're closer to the top of the market than we are closer to the bottom of the market? And my suggestion is this, pretty much. If you've got real estate that you've wanted to get rid of in the past, that you want out of your portfolio, now's the time to sell it because you're going to get over the top prices this year. I've got a few apartment complexes even that people try to buy apartment complexes from you every year. They're just constantly trying to buy them out from under you because they're so beautiful to own. And, this year I thought about maybe even letting one or two of them go this year, to be honest with you, Mike, and taking some cash off the table, taking some of my, my net worth off the table and stick it in the bank and let it sit there. However, the problem with that is I have the exact same problem you have, Mike, which is I've already got money sitting in the bank waiting for the next recession. I don't need to take anything off the table. So then you ask yourself this next question that makes it easier for you. Would you, if you didn't own these houses that you have right now, would you want to still own those houses? Are they making you cash flow? Are they positive cash flow? Are they hard to operate?
Not at all.
Then, okay, you answered first question. Keep what you got. Now go on to the second question. With the interest rates what they are and the rents as high as they are, can you still produce a 10 to 20% cash on cash return?
Absolutely.
Then I say keep buying.
And probably what I should do with the original house that I've had it so long is just paid down is I probably just need to refinance it at today's even lower interest rate and pull equity out of that so I can have more cash to keep buying.
Absolutely the best idea you could come up with yet. Interest rates are even lower this year than they were last year. And I thought last year they were going to go up. I really did. When they stopped the quantitative easing, I thought that was going to be the line, the curve where it started to go back up. But it didn't. It turned right around and went back down. So it doesn't matter how smart you are, you can't figure that one out, huh? I couldn't figure it out. So I'm go ahead.
I'm sorry. Your last segment, you were talking. You were referring to an article from Fannie and Freddie. I don't know if it was from Fannie and Freddie, but it referenced them, and it was talking more of a macro level, what's going on in the country. But with Houston, we've all seen, and as investors locally, we're all sort of concerned about the drop in oil prices, and oh my gosh, are people going to start losing their jobs? Are we going to get hit with a Houston recession? And what does that mean? Where are you? What have you seen on that? And are you concerned? Are you not, because we're better diversified as a microeconomy now, or are you? What are they saying there?
I've actually got a 5 or 10 minute dissertation on that, to be honest with you, because I've done a lot of research into that. And I do have sort of a gut feel about it. Unfortunately, in this particular segment, we've only got about 30 seconds left, so I couldn't do it in this particular segment. If you want to hang on to the next segment or call back in the next segment, I'd be happy to cover that, because I do have a feel for what everybody out there is saying is going to happen, because we know they've already started laying people off. I got an email the other day, one company laid off 7,000 people. Now, they weren't all from Houston. You realize that we're not the only oil state out there, right? But we're definitely more weighted in oil than anybody else is. So we're going to take it on the chin for some employment. There's no doubt about that. However, there's some mitigating factors that have come up that are going to make us take a second look at this before we go running for the hills. And I think I'll cover those for you when we come back from the break.
Welcome Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Our number here is 866-945-6565. Where's the economy going? What should we do? How do we take advantage of it? And how do we avoid getting caught up in it, as it were to say? So, Mike, we're going to talk about the Houston economy, and you can drag Texas economy in there as well. You have to start at the beginning because there's really 4 different levels to this conversation. Now, where did I get all this gibberish I'm about to share with everybody? First of all, I called all the economists I know every year, and I know about 4 of the top ones in the country. Those guys have already called all the oil economists that they know, so they've already got their predictions of what not's going to happen. Those economists also call all the top oil companies and get whatever research they can get from them for the economy, because they've got to write all these economic research papers also. So all these people are chasing all these ideas. And here's the story, if you like to call it that, Mike, and that is, number one question is, who's doing this stuff? And then why are they doing it? Who are the winners and who are the losers of all of this war on oil? And interestingly enough, the conspiracy theory, and there are guys out there that actually have this conspiracy theory, they believe the U.S. government's involved in it. And they believe that they're tied to the Arabs, and that Saudi Arabia is really, really worried about ISIS and really worried around Iran and Iran getting the bomb. And now that they just took over what was a little country they just threw the king out of just a couple days ago, they're surrounded. And Saudi Arabia is really afraid of this situation. Of course, they're our allies, and so we're in cahoots with them. In addition to that, we are also irritated about Iran, and we're also irritated about Russia being in the Balkans. So by dropping the oil prices, what you have to understand is that only a few countries can survive, that are oil-producing countries can survive if oil is low. And what you have to see is that they can bring oil out of the ground cheaper than we can, right? And by the way, the other thing the Arabs don't like is all of our fracking and shale oil and all this stuff coming out of, the Dakotas and Canada and everything. And so they want that stuff to go away. And by lowering the price down below $50 a barrel, that stuff basically shuts down because it costs us too much to get that oil out of the ground. Well, these other countries like Iran and Russia, they get it out of the ground cheap. But the problem is they're socialist countries. Their entire country lives off the money that comes out of the ground as oil. And so there are dollars necessary for them to survive. And like Iran, who sponsors terrorism, they have to have like $100 a barrel oil to survive. And so when you drop it down into the 40s or 50s, Iran is going to have to stop sponsoring terrorism. They might even have to stop going after nuclear warheads. They're going to have to do something because they're going to starve. And that's the idea. So the question is, who's going to actually get hurt by this? It's going to be the Russians. It's going to be third world countries that live on their oil. And then you have to ask, well, how long can they allow that to happen? Well, America can allow it to happen as long as Saudi Arabia wants to, because we're not living as a country as a net producer, although we have been the last couple of years a net producer. We ramped up to become a net producer, but there's no need for us to be a net producer. Now, look at who that benefits. The Democrat, who doesn't really want oil in the first place, is very happy to see oil production stop dead in its tracks. Secondly, low gasoline prices is great for the economy everywhere except Texas, and makes it look like for his presidency that everything is great. That, look, he saved the world with oil, now there's cheap gasoline. So these are what the people believe are making this happen. But then you've got to ask yourself this next question, that is, how long can they do that? And how far will they take it down? Well, according to what these economists are telling me, they think oil goes back up to $80 a barrel. Mike, that's it. So here's the deal. That's the second layer. They see oil coming back up to the $80 a barrel range by mid to late 2015. Now here's the third level. The third level is, okay, so Texas takes it on the chin, and we start losing jobs. Is the bottom going to drop out of Texas like it did back in the 80s when this happened? And most experts are saying no for a couple of reasons. One, we are more diversified, like you made the point, Mike, that we are more diversified where we are right now. But secondly, what these economists are telling us, and again, I got it secondhand from my economists who talked to the oil economists, is that the oil companies have invested a lot of money to buy new leases since they thought they're going to start producing, that we were going to get to be a net producer. And they've got money in these leases, and these leases are time problematic. In other words, maybe the shale won't work. Maybe you can't get it out of the ground cheap enough to make it work. But these other wells, these deep wells, they are going to stay going. They've already paid for the leases. They've already bought the rights to the drills and all the equipment, and they've borrowed the money to spend to do these projects. These projects are already a go. So it would take some time, number one, for that to completely wipe out the Texas market. And secondly, they believe this is only a temporary thing, that there is a creation of this problem on purpose because of Saudi Arabia's situation out there in the middle of all that war going on. They're just trying to freak those people out like, hey, stop coming after us or we're going to freeze you out and starve you out, et cetera, et cetera, et cetera. So with that said, Mike, let's go back to your basic statement that you started with, because it really is full circle back to what your statement is that, is there enough other industries in Texas to keep us afloat? Yes. But there's one other point. The fourth level these economists brought to me was this, that there's no place for the people in this world to put their money right now. Absolutely no place for them to put their money. That the lower, or our treasury bills are 1.5% return, and that is the highest treasury bill of any country in the world right now. So where do these billions and billions of dollars of these other countries' money going to get stuck? It's going to get stuck in America. And where is the fastest growing places in America? Texas and others. But Texas is one of them. So this money has already been committed. It's already here. Our banks are flush. Our construction is flush. Apartments are being built. Buildings are being built. Could all that become overbuilt? Yeah. But it isn't going to happen today. It's going to happen next year. Mike, we're still good to go. Keep buying and keep enjoying it. But make sure you buy stuff that you really want and that really cash flows. My friends, that's how I see that. Mike, I hope that answers your question. Mario, hang into the next segment and we'll get you taken care of. We'll be right back with the Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Holding through the break is Mario. Mario, how can we help you today?
Hi, Del. Thanks for taking my call. I recently heard you talking about an out-of-state investor that was buying properties. Now, my question is, what strategies does a typical out-of-state investor use in order to purchase, rehab, and put a tenant in a property in a single family?
Well, we've got lots of different ones, Mario. Some people are just really hard workers. They're willing to get out and get things done. I've got a guy that lives in Guam.
That's the one I was talking about.
The reason he's able to do what he does, Mario, is because he actually works as a pilot. So he can fly back anytime he wants. Now, it's a long flight. I think it's like a 12-hour flight. But he can fly in. So if somebody finds him a deal, a house or something he wants, he'll fly in, he'll take a look at the deal, says, yep, I want that one, write the contract for it. Or many times he'll just write the contracts because someone tells him, hey, that he trusts that this is a good deal, you should buy this one. And he'll write the contract, then he'll come in and look at the thing, inspect it, he'll sign a contract with a rehab company to rehab it, and then he'll rent it. And he has no problem renting houses, just like none of us do. And right. He says that he actually takes care of that stuff from Guam, all over the phone type thing. Other people, however, take a different tack. Many people will come here, buy stuff, and then take and put a property management company in charge of it for them, and that property management company will take care of the day-to-day activities. So that's another way that people do it. And a third way is that some people actually just partner with somebody locally they like and trust, and they do business with them. There's a lot of passive investing going on that way around here, where people come in, they get to know people, and then they just invest with them passively.
Okay, great. And another question, if I may, a quick question. What's the typical equity capture you're seeing in today's market?
Wow, it's way down, way down. I've heard tell of people taking and only being able to capture $10,000 in a house nowadays, which is still a good amount of money. I mean, if you think about it logically. And here's why I'm going to say it's logically, okay? Back 2008, when the market had crashed, we were picking up $40,000 of equity in a single house and putting down zero amount because we're buying them so below market that our hard money lenders would give us all the money to buy them and rehab, and we'd have nothing invested. So that's an infinite rate of return, right, with massive upside. As the prices continued to rise through the last 4 or 5 years, now you're in a situation where you'd be lucky if you buy the house $10,000 below market, and you'd be lucky if you get in for $10,000 down. Well, $10,000 down would make that 100% rate of return, and that's a ridiculous concept to say that 100% rate of return is a small amount. But what may be more realistic is that you have to put $20,000 down, and now you've got a 50% rate of return. But I still think real estate is so skewed intellectually that it just doesn't make any sense. If we were to take a guy that had never done real estate over the last 5 years and say, Mario, look, you're in the stock market right now. The stock market's up 20% this year. You could have made a 50% instant gain by going into this deal and then cash flow of 10 or 20% or better. I think people go, that's unheard of. You can't do that. That's too good. It can't be true. And that's why I think even now in this upward trending market, you can still buy investments that are better than any other investment out there, bar none, compared to anything else that's out there to buy into.
All right, got it. Thank you very much.
All right, Mario, thanks for holding through the break. Our number here is 866-945-6565. We started the day off talking about rule number 3, you can't get rich slow. I wanted to share with you that in all of my days of owning over 100 houses, I only purchased 11 houses individually because I figured out very, very quickly that there was no way I was going to get rich buying one house at a time, and especially, and this is interesting for Mario's conversation, especially back when I was buying when interest rates were anywhere from 9 to 11%, some as high as 12 and 13, but the stuff I was buying was 9 to 11%. And interestingly enough, because interest rates were so high and the rent was so low, we only made about $200 a month per house. So it was going to be impossible at that kind of return to get where you want to be by buying house after house after house. Nowadays, it's a little different. Nowadays, with the interest rates so low and the rent's so high, I see people all the time getting $400 or $500 a month, even $600 a month positive cash flow on the homes that they're buying. So you can get a pretty good bang for your buck when you can pick off deals at that kind of a cash flow level right away. However, it still isn't going to get you to the level that someone who buys groups of houses or apartments is going to make. And that's what happened to me. I didn't understand how to do apartments. I had no idea how they worked for years later. So what I did was I started looking for opportunities to buy groups of houses. And the first thing I found was 5 duplexes, which is 10 units. And I bought them all from one guy on an owner finance note. And so that paid me about $2,000 a month. Now here I was, I had about 11 houses, and they were already paying me, $2,000, $2,500 a month. And I pick up another $2,000 a month all at once. All of a sudden I'm making $4,500 a month. Well, you have to realize back at that time, this being tax-free income, that was equivalent to what I made at my job. I only made $70,000 a year. After taxes, I only took home $50,000 a year. So here it was in just this short period of time. It took me this period of time to buy these first 11 houses. I don't know the exact period of time. I'd have to look it up, a year, whatever it was. But then, boom, I went out and bought 10 more all at one time. And there you go. Now I'm at $4,500 a month. That's a big difference, friends. That is a major difference. And so I told myself at that point that I wasn't going to buy anything ever again unless it was better than something else that I already had. And I was going to get rid of my small ones and buy larger ones and keep pushing myself to do that. So at that point, the next thing I bought was actually 15 duplexes in a subdivision where I own the entire subdivision. It was 30 units all at one time. And this thing put out about $3,000 a month. So you're sitting there right now, 2.5 years after I started investing in real estate, I was making more money on my 50 units than I was at my job. And it made it very easy for me to see it was time for me to get out of my job. Why work 12 hours a day, 6 days a week to earn less money than I worked 1 or 2 days a week? And it didn't make any sense. So I got out of it. Now, after that, I then realized that apartments, how they worked, figured that out, had somebody teach me or figured it out or worked through it or whatever, went out and found myself some education on it. And as I worked through apartment complexes, I realized I needed to grow larger and larger. So I bought 20-unit apartment complexes, and then I bought 40-unit apartment complexes. One time I bought a 12 and 8, that would be 20. Another time I bought 20-unit all by itself, and another time I bought a 30-unit. No, I take that back. It was a 40-unit apartment complex. Then I bought a 64-unit, then a 68-unit, then an 88-unit. Then I bought a 140-unit, then I bought a 140-unit. And it just kept growing from there. Another 140-unit, then I bought a 256-unit, then a 270-unit, and then a 320-unit. And each and every time I grew larger and made more money and became wealthier and wealthier and wealthier, but not at a straight linear rate. My wealth grew exponentially. And that's the key. That's what it needs to do. So it needs to grow exponentially so that you realize becoming extremely wealthy, so that you realize economics of scale and the ability to bring people in over your real estate and operate it for you so you don't have to operate your real estate. All of these things are important factors involved with growth instead of just one house, one house, one house, one house. Now, I've seen people that have done that, and I had one friend who bought 70-some houses whose kids now work for me. He's dead, unfortunately. But, I mean, he worked those 70 houses all the way until he died. And the bottom line was he worked way too hard and had a good life. But what got in the way, what his good life got in the way of was a great life, making millions and millions of dollars and having everything done for him instead of him being involved. So, my friends, the rule number 3 that it took me years to learn was that you can't get rich slow. We'll be right back with Del Walmsley Radio Show.
Welcome back. Now here's some more unconventional wisdom to set you free from the man on a mission to retire America, one person at a time, Del Walmsley.
Our number here is 866-945-6565. Holding through the break now is Paul from Seattle, Washington. Paul, how can we help you today?
Yes, I have a couple properties that are paid for that are rentals, and then I have my house, and I have another one that's not paid for that I have a lot of equity in. And I've been listening to you, and I wanted to take some of my money out and, turn those net. And I wanted to figure out how you calculate the 27 and a half years of the depreciation so I can show all the numbers to my wife and explain to her how this works.
First of all, it has nothing to do with taking money out. So when you take and pull the money out, which, by the way, is a very wise move, and if you've been listening to me, you already know the answer why that is. But that is a good move. Secondly, it has nothing to do with that. So how do you do it? You take whatever the value of your house is and look it up on the tax record and figure out what part of that value is improvements and what part is land. You can't depreciate the land. You can only depreciate the improvements. So you take whatever the value of those improvements are and you divide them by 27 and a half years, and that's how much of a write-off you'll get each year on that house. Now, that's called straight line depreciation. There is an accelerated manner to do it, but you have to have a CPA to help you do that, because what you have to do is break the house up on your tax return into component parts and depreciate each component part. Like, say, the roof would be depreciated over a longer period of time than, say, the carpet would, because the carpet's going to wear out really quick, and the roof's going to last for a long time. So you'd have a 2-year, 5-year, 7-year, 10-year, 15-year, and 27.5-year depreciation segments that your CPA would break your house value up into, and then really you might be carrying 7 different depreciation schedules on that one house. A lot of work to do that for a house, so most people don't do that, Paul. We do it in apartment complexes because it means doubling our depreciation, which is quite nice.
Yeah, I'm just looking at talking with my wife and showing her the numbers, and we have two houses that are paid for that are worth about $200,000 each. We have another house we have $180,000. So I got like $500 and some thousand of equity that I could just pull out right now. And I was thinking about buying some more houses or an apartment or doing something. But so with that, I'm just thinking right now we got that income coming in. We have to put it on our income taxes income because the houses are paid for. And if by taking a loan out against it, I'll get that tax free. And then I'd be able to, I want to make it, I'm assuming what I want to do is make the loan that I'm paying to the maximum amount of my depreciation, so I'm getting that money tax-free. So just take enough of a loan to where I'm getting the same amount coming in on my rent, that is equal to the depreciation we're writing off every year.
Right. You want the net. You want the net of what you get to keep after you pay your mortgage payment to be equal to the depreciation. One thing I would recommend, though, Paul, this is my 30 years experience speaking to you with a gentleman with just 2 houses to start with, is a couple of things I'd like to suggest. Number one, pull everything out you can pull out because rents keep going up and the depreciation doesn't get any larger. It's going to go, it's only going to be as much as it's going to be. So get as much out as you can. Interest rates are at all-time lows right now. Lock those interest rates in, these very low rates, and you're going to be sitting pretty with those houses for the next 30 years. Get 30-year amortization loans so that you get more cash flow out of the deal over the long haul. And don't give up those interest rates. That's the beauty of locking them in for 30 years.
Mm-hmm.
The other thing... one more thing I want to share with you, and then I'll let you ask as many questions you have. The next one is, I really would look into taking that $500,000 and going buy an apartment complex with it in this marketplace right now because houses are very high. You go get yourself a good apartment deal, and you're going to earn right out of the blocks anywhere from 10 to 20%. And on $500,000, that's $50,000 to $100,000 a year tax-free coming at you right away. So I'd take that into consideration.
Yeah, I've looked around for apartment complexes in the Seattle area. I've been on the internet a lot, and I haven't seen any available, but that's beside the point right now. My last question is, at the 27 and a half years, what do you do with your home? You started buying when you're young. After that 30-year loan's up, do you have to sell it, or do you just refinance it again at 27 and a half years of depreciation starts over? How does that work?
No, it does not start over. Once it's gone, it's gone, so you got to get rid of the house. I sold all my houses off about year 10 and went strictly to apartments. So, somewhere along the line, you're going to need to get rid of those houses. But it's, 27 and a half years is a long time for almost everybody. Mm-hmm. That's not like a rush issue. But when I teach in my classes, I don't think people should keep real estate longer than 5 or 10 years. And they need to get out of it and get something more leveraged because you're not taking advantage of it. Think about how much money you're not making because of those houses being paid in full. And think about how much taxes you're paying because they're not leveraged enough, so you're paying taxes on all that cash flow you're getting out of them. So I think you're thinking the right things, and I'm hoping that you are going to do those right things. But the depreciation does not start over again.
Okay, so after that's gone, it's gone, so then you pretty much need to get rid of the property. That's what I kind of thought. All right, great. Thank you for your help. All
right, Paul, call anytime. I've got an email here from a lady I want to share with you how quickly something like this can be done. This lady was actually called live a week or so back, but this email that she sent me really fills in the rest of you can't do this slow. Just wanted to let you know that we closed on the remainder of our Roth today. We only had about $18,000 left in that one. Something left since we brought out the $400,000 when we started this circus ride in 2012. We still have over $300,000 stuck, as we call it now, in stupid thrift savings plans. We can't get it out until we resign, but because of you, we intend to resign from the post office in a few months. However, thanks to you, of course, we have the income that we can afford to do that. Let's face it, it really would only be, oh no, they're talking about something else. It goes on and says, you may have also forgotten we sold all of our stocks too, and listened to you at that time, so we did not lose all the money when the stock market crashed in 2008. If I could go back, my one wish would be do it all over again would be to start sooner. Oh, well, at least we did it and we acted on it when we did find it. We just closed on January 2nd, 2015. Our last 24-unit apartment complex now gives us a total of 140 doors. And so I asked her how much money they made, and she said she's making $20,000 a month tax-free. Her and her husband both work for the post office, $60,000 a year salary after 20 years of work, hard work, $60,000 a year. They're making 120 grand a year, both of them working long hours, hard work. And now they're going to retire and make double that amount, tax-free, which means instead of taking home $80,000, they're going to be taking home $240,000 a year. But remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Del Walmsley radio show are those of the host, Del Walmsley, his guests, and his callers, and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Del Walmsley show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Del Walmsley show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.